morning, welcome to 3 Minutes on Markets and Money. It is Thursday, August the 6th. Talking a little bit about the markets. Hey, guess what, folks? The S&P 500 is only 2% away from all-time highs. Not surprising. We've been talking about this for the last couple of weeks. The NASDAQ, of course, is already at record highs and has been really kind of dragging up the S&P with it. And the reason is as simple as that both indexes pretty much have a lot of the same stocks. And most importantly, the five that matter: Apple, Amazon, Facebook, Google, Microsoft, and that's really been lifting those markets in general together over the course of the last couple of weeks. And it's interesting right now because Facebook, Apple, Microsoft, Amazon, Google make up as much of the market as financial, energies, industrials, and materials combined, the whole sectors. So it's pretty much on a market cap weighted basis, the five stocks are now consuming more and more and more of the index. So it's not surprising when those stocks are moving, it is moving the index with them. We are now within 2% of all-time highs, and this is, of course, after we broke out of this consolidation channel. We've been doing this here for a while. It's kind of building these consolidation channels, breaking out, but not really going anywhere, right? We kind of break up a little bit, travel sideways, and here we are, we're breaking out again, and likely going to kind of try to get above all-time highs. The markets really want to get there because it's just simply so they can claim victory that we got to all-time highs. That's the way markets work, but it's all psychology. But importantly here, though, we do have a money flow buy signal back in place. That's starting to accelerate fairly quickly here. And of course, we've also triggered a MACD buy signal as well. So really everything here is lined up here for the markets to hit all-time highs in the next couple of weeks. Wouldn't be surprised to see this happen by next week at all. After that, though, that's going to be the big question, because once we get to all-time highs, we still have to deal with weaker earnings growth, weaker economic growth. Tomorrow, Friday, we've got the big employment report coming out from the Bureau of Labor Statistics. ADP report only showed 167,000 jobs created for the month. Right now, estimates are for 1.4 million for the BLS report. So there could be some disappointment on that. That wouldn't be surprising. We're seeing a lot of economic indicators already suggesting that the employment recovery and the economic recovery has started to stall out here a little bit. You know, this is very bullish right now. Everything that's been happening lately in the market has been very bullish to the upside, keeps our portfolios allocated towards equities currently. We've been adding some positions here and there. But again, we are very extended over long-term means. These deviations from the 200-day moving average typically don't last for a long time, and typically they do lead to corrections. And even though a breakout like this is important and suggests that over the course of the next 12 months, we will have positive returns from the markets, typically in the short term, you do have corrections. So again, just as an example of this, be a little careful chasing markets here. I know it's exciting here and we're all making money and it all feels good, but this is typically too where you kind of get set up for at least a short-term correction. Nothing major, 3 to 5%. We come back down, retest the 50-day or the 200-day moving average, certainly within the realm of possibility, but that would certainly also really jigger the market short term. So again, just kind of pay attention to that. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. Have a great Thursday. We'll see you next time on the next edition right here at realinvestmentadvice.com.